Welcome back to episode 97 of the Crynet GenShow. I'm your host, and today we're doing a deep dive into the second week of August 2026, which is officially demonstrating what institutional accumulation looks like, behind closed doors.
Yeah, it really is a massive disconnect.
Right, because on the surface, you've got this tight horizontal range. Bitcoin is anchored right above that $63,000 support line, which is keeping retail sentiment totally in check while macro headwinds blow.
Exactly. I mean, the retail crowd just sees flat charts. The fear and greed index is sitting at a really cautious 42. So everyday investors are they're just waiting.
Well, they're waiting because the macro environment kind of stopped throwing surprises at us. U.S. CPI came in at exactly 2.7% year over year.
Right, which matched expectations.
Yeah.
So that calms all those immediate fears of, like, Federal Reserve rate hikes. The surface waters are completely calm.
But then you peer under the surface. If you look at our stack of institutional research reports today, Wall Street is just aggressively vacuuming up supply. Regulated spot Bitcoin ETFs just snapped weeks of redemptions with, get this, $853 million in net capital inflows.
It's staggering.
Yep.
And that's largely led by BlackRock's IB. It's a total vacuum. And it's not even just Wall Street doing it.
Right. Corporate treasuries are accelerating, too.
Oh, absolutely. You've got mid-cap tech companies across North America and Asia, and they're actively adding Bitcoin and Ethereum to their corporate treasuries. Like, they're doing this to build a direct hedge against fiat inflation.
So wait, for the listener, is this kind of like, think of it like an engine running in neutral. The car itself isn't moving, right? The price chart is totally flat. But the RPMs are absolutely redlining because institutions are quietly hoarding all the fuel.
That's the perfect analogy. And for traditional finance to actually use all that fuel they're hoarding, the underlying blockchain plumbing has to be capable of handling Wall Street level volume.
Which brings us to the infrastructure side of things. So looking at Ethereum, mainnet gas fees dropped to multi-year lows. They're sitting below 5 GWR.
Yeah, that's a really key metric this week.
But wait, I have to push back on the prevailing narrative here. If nobody is paying for block space and fees are dropping to near zero, doesn't that mean the network is, dying? Like users are leaving?
I mean, on its face, yeah, you'd think that. A massive drop in fees usually signals a drop in demand.
Mm-hmm.
But the on-chain metrics show the volume hasn't disappeared at all. It migrated.
Oh, so it moved somewhere else.
Exactly. The Ethereum ecosystem is undergoing this massive structural shift toward layer 2 rollups. Arbitrum, Base, Optimism. The network isn't dying, it's successfully scaling.
Ah, so the main highway isn't empty because people stopped driving. They just built a massive high-speed bypass system that everyone is using instead.
Right. And builders are doubling down on this. Web3 developer activity just hit an all-time Q3 high, with a major focus on zero-knowledge rollups.
Which is huge for privacy, right?
Exactly. It's a non-negotiable requirement for traditional banks. They need to protect client privacy on a public ledger. And we're seeing that momentum outside of Ethereum, too. Solana's total value locked just reclaimed the $5.5 billion mark.
So the global infrastructure is rapidly expanding, and this is all happening while the U.S. Senate officially delayed the Clarity Act vote until after the August recess. Washington is stalling.
Washington is stalling, sure, but the regulators are still moving. The biggest signal in our reports today is that the U.S. CFTC just greenlit a pilot framework to test tokenized real-world commodities.
Wait, like physical gold and energy?
Yeah, agriculture, energy, gold. Traditional finance is building clear regulatory sandboxes right now to trade physical assets directly on-chain.
Wow. I mean, putting the title of a physical gold bar on a blockchain changes the physics of trading completely. Moving $10 million of gold becomes as frictionless as sending an email.
Settling in seconds for fractions of a penny. Add in Ripple expanding its enterprise cross-border settlements in the Asia-Pacific region. And, the picture is undeniable.
The rails for the next era of global finance are being laid down in broad daylight.
While the flat price action keeps the broader public completely distracted.
Exactly. And that wraps up another high-value deep dive for episode 97. The central takeaway here is crystal clear. Price action only tells half the story.
Right. When $853 million floods into Bitcoin ETFs during a boring market, structural demand is silently building the next floor.
Spot on. The regulatory timelines might shift into September with the delayed Clarity Act, but on-chain activity and corporate treasury growth, they aren't waiting for Washington.
Definitely not. You have to track the capital flows, not the noise.
So I want to leave you with a final thought to chew on. If these regulatory sandboxes for tokenized commodities and corporate integrations are being quietly finalized right now during a so-called boring market, What happens to global supply and liquidity when traditional finance finally flips the switch and takes these systems live?
It's going to be massive.
It really is. All the technical data on the ETF inflows, gas metrics, and regulatory updates are linked right below in our show notes. Protect your private keys, leave your emotions out of the market, and I'll see you in episode 98.